In this video, we're going to talk about Clover Health, trading under the ticker symbol CLOV. Clover Health is a healthcare insurer focusing but not limited to Medicare coverage. The company focuses on providing affordable solutions to those in need and uses the internet as their promoting platform to optimize their cost structure. Its operations are headquartered in Nashville and has presence on both East and West coasts of the United States, as well as an office in Hong Kong. Clover wants to change the medical insurance landscape, and it believes that the internet is the best leverage tool that allows the company to reach this goal. Clover is one of the fastest growing insurance networks back in 2020 and 2021, claiming that its membership has been growing by at least 20% each year. It has a flexible and growing broker community, allowing Clover to see its products reaching ever more Americans. For the clients, the main appeal to Clover is the low cost and wide coverage. For the market participants and potential investors, Clover represents a potential actor in changing and improving the current insurance landscape with better scaling capacity and more optimized cost structure, which may lead to better profitability in the long term. The trading volume of Clover has been recently 14.5 million shares compared to an average volume of 12.1 million shares. Over the previous 52-week period, its price has been fluctuating between $3.68 and $28.85. The market cap of Clover is currently at $1.8 billion compared to an EV, so enterprise value, of $3.1 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company, based on its current fundamentals, leverage, asset compositions, and so on. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which may in turn negatively impact its profitability and even solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth type companies. For many of those, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the company can generate more profit or to have more growth than another company, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies can use. However, it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, knowing that the enterprise value includes both tangible and intangible assets. In comparison to its historical price fluctuations, the stock is 1.1% higher than the 1-month low, and 1.1% higher than the 3-month low. Same goes for the 52-week low. In terms of the options market, which often gives a hint on the market sentiment on where the stock price is, the implied volatility is 85.1% compared to a historical volatility of 56.4%. The put-call volume ratio is currently at 21%. The most recent volume of options traded has been 25,000 contracts within a day compared to the 30-day average of 33,000. In terms of open interest, the most recent volume of open interest has been 330,000 contracts compared to a 30-day average of 501,000 contracts. In terms of its shareholder structure, institutional shareholders hold 22.8% of its outstanding shares. The biggest shareholders include PNC, Vanguard, and Green Oaks Capital. The relevance of the shareholder structure is important because it determines, or at least plays a huge part in determining whether you should be holding the stock long term or view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment instead of being perceived as a short-term trade. Let's also look at the short interest present in the stock, which is the amount of the positions that aim to profit if the share price falls lower. Sometimes, if there are a significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what's going on with GameStop or AMC. So, for Clover, the short interest is 8.36% of the total float and 34.7% of the dark pool transactions. Let's also take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 0 sell, 9 neutral, and 2 buys, and overall, it's suggesting an overall tendency of buy. The moving averages, or MAs, of the past price action has 13 sell, 1 neutral, and 1 buy, with an overall tendency of strong sell. The moving average can be used to determine whether the stock is overbought or oversold compared to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $2.49, $3.81, and $4.62. For the resistance levels, they are $6.69, $9.16, and $12.87. Looking at Clover Health, I would say that the fundamentals aside, the current sequence of events has been proving challenging for shareholders, although it may not be necessarily that bad or affecting the company's operations that much, or at least by the same degree. Market participants, and more specifically retail traders, are attracted by the company because it is a stock massively owned by retail traders, expecting Clover Health to go up, which it did for a period of time, before going to another direction. It doesn't mean that a company is not worth of your money per se, but going in, you would have to understand the risks involved with your capital getting depreciated, which is a result of supply and demand, especially the short volume in the dark pool. My opinion on the company is that it is overall worthy of your time to at least take a look and interest at it, and that it deserves to remain on your watch list and eventually in your portfolio if you're future oriented. With that being said, I would recommend not going in now and instead buying them in small batches when it has found some new support, which has yet to happen for the time being. Of course, the exact time frame and time window for the entry depends on when the stock finds some significant support. With that being said, a key event that needs to occur is an uptick in order for retail traders to have a chance to parry some of the selling pressure from the short sellers of the dark pools. In terms of its price action, the downward trend is still ongoing, and I believe that it should continue for some time as we move in 2022, so definitely it's something to keep in mind. This may be explained by the fact that investors have been looking elsewhere from the popular stocks back in 2020, such as in the short squeeze stocks, and many of them have put their money in other popular spots like the short squeeze stocks. My recommendation is to make sure that your exposure in Clover Health is at a maximum of 0.5 to 1% of your portfolio, but to keep an eye out for any potential support in sight. As we mentioned before, right now, it would be recommended to follow up to the stock for a good entry point, which may only happen within the next few weeks or month. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.